For years, gold has been one of India's favorite investments. Now, the government wants that demand to slow down. Days after Prime Minister Narendra Modi urged Indians to avoid buying gold for a year, the government has raised import duties on gold and silver to 15%, up from 6%. And this is not just a tax hike aimed at jewelry buyers. It is part of a broader strategy to reduce dollar outflows, protect forex reserves, and shield the economy from global uncertainty linked to the West Asia crisis. The government has imposed a 10% basic customs duty along with a 5% agriculture infrastructure and development cess on gold and silver imports. Earlier, those rates stood at 5% and 1% respectively. But why is India worried about gold imports? India does not produce enough gold domestically. Nearly 90% of the country's demand is met through imports. And in India, gold buying is not just financial, it is deeply cultural. Every year, the country consumes around 700 to 800 tons of gold through jewelry purchases and investment demand. That's exactly where the concern begins. Gold imports are becoming expensive for the economy and are putting pressure on India's forex reserves. In FY26 alone, gold imports accounted for nearly 9 to 10% of India's total import bill. Imports also jumped 24% to hit a record high of nearly $72 billion. So the logic is simple. Fewer gold imports mean fewer dollars leaving the country. Experts estimate that even a 30 to 40% reduction in gold imports could save India $20 to $25 billion annually. That would help protect forex reserves, narrow the current account deficit, and support the rupee. India has already been trying to curb imports in recent weeks. The government imposed a 3% Integrated Goods and Services Tax or IGST on imports, which temporarily forced banks to pause gold imports for more than a month. As a result, India's gold imports in April fell to a 30-year low. With duties now even higher, experts expect imports to slow further. The impact could be visible almost immediately. Gold jewelry is expected to become more expensive. Higher prices may reduce both investment demand and ceremonial buying. At the same time, investors have already started shifting towards paper gold. According to the World Gold Council, inflows into India's gold exchange-traded funds or ETFs surged 186% year-on-year to a record 20 metric tons in the March 2026 quarter. Industry experts say consumers may now postpone jewelry purchases, exchange old gold for new jewelry, or increasingly shift towards gold ETFs. But there's also a risk. Experts warn that sharply higher duties could revive gold smuggling, an issue that had eased after tariff cuts in mid-2024. Ultimately, the move is not just about discouraging gold purchases. It's about reducing pressure on forex reserves, narrowing the current account deficit, and supporting the rupee during a period of global uncertainty. The broader goal is to limit speculative gold hoarding without slowing economic activity. Follow Business Standard for more such stories.